Good morning, Scott. How you doing?
Fine, thank you. How are you doing, Ryan?
Doing good. Thank you very much for coming on the Life After Business podcast.
Appreciate that. Appreciate the invitation.
I'm pretty excited for our conversation today because we had met at the exit planning training, and you had given a couple of presentations, and you were easily the most memorable because of the hats and the way that you put some spunk into the topics that we were talking about. So for the sake of our listeners, can you give them a little bit of a backdrop on where you came from, a little bit about your past experience and where you are today?
Well, thanks for the easy tie-in here. I am a serial entrepreneur. I've been a business owner. I've started businesses. And a long time ago, I actually became professionally accredited. I am a CPA and logged a few years in public accounting, but that wasn't a long-term goal. And so I was with them for a very short period of time and then went into industry. So I've been an owner in several closely held firms. For today's purposes, one of the high water marks before founding the firm Enterprise Services, I was a CFO for a large manufacturing firm that had an employee stock ownership plan, an ESOP. And the company quickly migrated to world-class manufacturing, and that's one of the core aspects to success as an entrepreneur, that being the consulting as it relates to companies considering or companies that have ESOPs. So I focused on founding Enterprise Services, and today we've grown within a niche market to one of the largest consulting firms in this niche. So
Serial entrepreneur at its finest, right?
well, yeah, there's always you're not hearing about the missteps.
It's all, well, you get to give the perfect little cliff notes, right?
That's right. Knowing that most entrepreneurs misstep two or three times or more before they finally, figure some things out and ride a winner for a while.
Well, and why I'm excited to have you on and have this conversation is because we've both been in the driver's seat. We've both been a business owner and had to write the checks for payroll. And, with your progression through owning companies and then to getting to where you are today, I think, what I noticed in the conversations that we had in the training was you're able to distill this down into a very practical, easy to listen to style. So, some of the topics that I want to touch on today are, because of your expertise, is really business valuation. And as owners are looking into their company, and a lot of people have seen the stats, and a lot of business owners don't know the actual value of their company to a potential buyer. So, can you give us a little bit of a background on valuations? What are some of the different types of valuations that business owners can be looking for?
Well, certainly. And the world of valuation can be rather confusing because it's a world where, in many cases, there's a formal valuation analysis for gifts, estates, for ESOPs, or even for litigation, where there is a formal report that is subject to review or even subject to challenge under adversarial proceedings. And many valuation professionals are trained, and they have lots of credentials. They're trained to these exacting standards. Well, in most cases, that's the world of theory, not the real world of actual transactions and how things get done. Then when we look at, the world of most business owners, they're not in the world of theory. They really, remarkably enough, right?
Right.
And then the question is, the company that in many cases they've spent a career building, is that going to be an attractive investment for, a next owner, either inside buyers like family members, key employees, or maybe even an ESOP, or to a third party, a competitor, private equity firm, a key supplier. So how does a arm's length buyer look at the value of the company. Most business owners would like to think there's an easy book. There's a way to acquire or purchase, or at least derive some sort of value for the company. And it's far more complex than that. In the real world, things are negotiated. So the bad one-liner in class is that you tell me the price and I'll tell you the terms. So the value of a company is probably going to be, really, integrally and involved with what are the terms. Very few companies are ever going to transact all cash. Every once in a while, there's some statistical outlier, but does not happen very often. So there's an overall consideration or approximate price, but then the terms. How is that price going to be realized? There can be all kinds of contingencies. There can be an earnout. There's a rather arbitrary holdback or an escrow account. There can be seller financing, again, which is hidden as contingent payment. There can be management agreements or employment agreements, and all that goes into this cauldron that's gurgling and bubbling as to proceeds to the owner. And then, not only that, then it gets far more complex because in this cauldron of various resources, certain of the aspects are taxed at much different rates. So, unfortunately, business owners would like to have a rather simple answer, and the fact is that it's probably going to be exceedingly complex based on contingencies, tax rates, how the thing is going to be structured, how much cash is up front. And that's something that most business owners really can't appreciate because they haven't gone through the sale process very often. In some cases, selling their baby, the company that they founded, this is the first time they've really had to look hard at this transition process.
Yeah, and you touched on so many crucial parts, Scott. And I think one concept
by the way, by making it complex, that's a sign of a good advisor. I'm just kidding.
Yeah, because we got billable hours on the forefront, right? But I in all seriousness is what one of the concepts that you touched on that I really want to hit home for the listeners is the difference between a valuation and net proceeds are significantly different, and the road to get to net proceeds is long and windy, but that's where everything's negotiable, right? So the valuation process, in my opinion, is where you want to just get a baseline number, so that way you can start going down that road to the net proceeds.
That's correct. And there's all kinds of strategies, depending on what side of the transaction you're on, but there's the gross proceeds, kind of a number that's puffed up. And then we get to net proceeds, as you've mentioned, after tax or after consideration of all the obligations, liabilities, taxes, and what have you. What does a selling shareholder or the business owner have after all of these? And that's where, there really is an art form in structuring the transaction.
So, because I want to touch on how you can, what kind of art form that looks like and the different scenarios. But when you're specifically talking about valuations, and what are the different types? So we've got different professionals, whether it's a CPA or a valuation specialist. There's a lot of different professionals that can do that. But when they're going in and the business owner gets a valuation, what are the different types of valuations that they can expect to see?
Well, when the introduction, or in that introductory few minutes, we can have very formal determinations of valuation. So let me at least start with that, because much of that vocabulary is fairly well known, and it's common vocabulary for the professionals. So there's the determination of fair market value, or FMV. That has great standing because those are tax-oriented assessments of value. tax-oriented for gifts, estates, ESOPs, and in many cases that's the standard that's been adopted by the courts for divorces and shareholder disputes, those types of things. There's a lot of documentation that's out there. There's pronouncements by the Internal Revenue Service that indicate, here's the approach, here's how you go about determining fair market value. But part of that definition assumes a hypothetical buyer and seller.
Theory.
In theory. So we're solidly on this muddy land of theory. But then we go back to good empirical data, rates of return from public companies and financial buyers. And there's a lot of good empirical data that is used and then can be subject to review. So on and on and on. I won't prattle on with that. But there's a lot of data that can be used from an empirical standpoint to derive a valuation number, or a range of value. Okay, that's the land of theory, and that's fair market value. Now we move on to the more pragmatic. So investment value would be the next item that I would introduce. Investment value, well, that's the value of a company or the value of an asset to a specific buyer. Everyone likes to think there's going to be a strategic buyer that's, kind of uninformed, is pretty dumb, and is going to pay an outrageous price. Well, that's not really the case. When we say investment value, typically it's the value of this asset to someone that's already in that industry. And then we have to look at and consider what is an overall consideration, kind of this gross consideration, but then that's going to be subject to terms. One of the things, now without prattling on too far here, one of the things is that who typically prepares all the documentation for a transaction? Well, it's the law firm or the attorney for the buyer. And that attorney is going to be, an advocate for their client, and they're going to want to protect that client from the unknown, things that we can't see, contingent liabilities. So the documents are typically drafted in a manner to provide a wide, real fluffy cushion for the buyer should something, kind of crop out from underneath a rock or something. There's going to be an offset here. So then, we have earnouts and seller finance and management agreements and escrows that are built into the world of transactions. And that addresses the key point that you had talked about, Ryan. What are the net proceeds? Well, the net proceeds, after we look at all these potential contingencies, could be much different than the original number that we're talking about. What's the value of the company before all of this? In the world of transactions, we always let them lick the candy, let them get the big number first. Then the surprises, all the deducts and contingencies, and you're not getting, in many cases, that much cash at closing, yet you're surrendering control of the company.
It's like the Hansel and Gretel story, where it's a little bit of a breadcrumb, and there's the oven at the end.
Yeah, we're enjoying this way too much, Ryan.
But when you talked about this big space, when you're talking about the attorneys and the unknowns and the T's and C's, so okay, we've got a valuation. Let's say that we're just this hypothetical scenario. We've got a valuation from some advisor, a report, or whatever it might be that gives us a gross number, and then from our experience, we were in a sales industry, so we're kind of bred to be on the negotiation playing field all the time.
Sure,
but I truly believe that a lot of business owners don't realize that all of this is negotiable. I mean, it's like a big, huge poker game. And the buyers are usually extremely sophisticated because they do multiple transactions and they know what they're looking for and why they should be discounting a company. And if you think about the example you talked about, the attorneys, for every attorney I've ever met, are risk adverse. So they're going to throw in all these contingencies. What is your advice? What have you seen through your the companies that you've sold or the experiences you've seen? Like, how do you approach this negotiation standpoint?
Well, certainly professionals or practitioners that are well versed in the world of transactions, they're really worth their weight in gold. They're able to distance themselves from the emotion that business owners typically are invested in with the company, their company, especially if they founded the firm and they started in a garage or a basement, that they're really not terribly objective about the firm. And if things are being said during negotiations, it's like, well, you're calling my kid ugly, and you take that as a personal offense, and yet it's just part of the process and protocols. So having a more collected, reasonable party representing you is tremendously important, because there's always going to be some warts, a couple of pimples, if you will, with every company. And those are going to be candidly brought out. They're going to be discussed. And you don't want a business owner taking that personally. So typically in the sale of a company, some good advice for business owners: do not use the company attorney that was pretty good on, sales contracts and maybe a little estate planning, but hasn't done any hard negotiations with asset or stock purchase agreements and contingencies and warrants and representations. That really is, turf for, practice professionals that have a lot of experience in this. Certainly that's our recommendation to business owners.
Well, that for our listeners needs to hit home, because we were a victim of that situation, right? Well, I don't know law, I don't know accounting, so we just use the people that we've always been doing business with, and that doesn't mean that they do a lot of transactions. And what I found is that being risk adverse from most of those professionals, when you're going back and forth with the letter of intent of the purchase agreement, and the buyer is telling you all these things that they want or don't want, the people that are not versed in this are going to take it more personally. I guess I don't know exactly how to articulate that, but they don't realize that the goal is to get the deal done. So there's got to be some give and take.
Correct. There's a lot of splay, and just because there's a letter of intent, it's not cast in stone. Literally everything's on the table, and if you feel strongly about one issue, there's probably some give and take on other items.
As we continue this conversation, and we're migrating into like the net proceeds and how those terms and conditions affect the net proceeds, can you give our listeners a brief overview of how that Rubik's Cube? I always refer to the Rubik's Cube of a tax and the net proceeds, because there's a lot of different classifications that can range from capital gains, ordinary income, and the different types of ways to structure it. Well,
thank you for the lead in. Generally, when a company is being transacted, there's two very common structures. There's an asset sale and a stock sale. A stock sale is typically favored by the seller, because with stock, almost certainly the extent to which there's any gain, it'll all be taxed as capital gain. And with a stock sale, the buyer is basically assuming any and all liabilities going forward, because liabilities will attach to that stock. Buyers, on the other hand, are hesitant. They don't want to buy stock in most cases, especially for most middle market closely held companies. They prefer what are called asset sales. With asset sales, they get to allocate the purchase price to assets that typically promise the highest return on capital. So allocating the purchase price to inventory, to receivables, that's very beneficial to the buyer. And even allocating the price to depreciable assets, enormously beneficial to the buyer, because they can get rapid cost recovery. Unfortunately for the seller, with an asset sale, many of the items that you're selling are subject to ordinary income. And as such, depending on the state that you're in, the ordinary income rates, the highest marginal federal and state rates can be very high. In high state or high tax jurisdictions like California and New York, the highest marginal rates on ordinary income are at or over 50%. They're
They're taking
arguably
half. They're taking half of your baby.
it's almost confiscatory.
Well, and I, you're touching on a very important subject because that immediately puts the buyer and seller not just on separate playing fields because it's a buyer and a seller, but you've got this massive tension about even how you want to code the overall purchase price between an asset sale and a stock sale.
Well, not only that, when you get into the weeds a little further, a business owner really needs to be thinking almost when they found the company, what's your exit? We've had a couple of exceedingly unfortunate situations where the company remained as a C corporation, not an S. And as a C corporation, the company's now for sale and someone's going to buy the assets. Well, there's a double tax situation. With a C corporation, taxes are first paid at the entity level. So the entire transaction's taxable to the company, and there's no capital gain distinction. It's all ordinary income to a C corporation.
Ouch.
Once there's a lot of cash in the C corporation, to prevent a holding company designation, and there's penalties for that, the cash is then distributed to the owners in a distribution that is then taxed at capital gains. So the combination of the taxes can easily be over 50%.
And which can completely derail the deal or be a massive, massive heartache when you realize that the tax bill's due.
Well, that plus bad news for CPAs. One of the emerging areas of lawsuits against CPAs is failure to advise business owners to change from a C corporation to an S. Year over year, it doesn't make much difference, but when you have the liquidity event because of the potential for double taxes, and that's when we really have unhappy business owners. They can't believe that the proceeds are just disappearing in front of them.
Well, and coming from our situation, you think that's why having the right person at the table with you is the first most important piece, because you need to make sure that you're relying on that person's expertise. I mean, it wasn't my job to know the tax brackets and not the tax brackets, the tax code, and how to actually use this Rubik's Cube of net proceeds to our benefit. And so you're relying on that person. And one of the things that I want to, so you got the asset versus stock sale and the ordinary income versus the capital gains. But then when you get into the realm of how and when you get your money, you get into these earnouts and promissory notes, consulting agreements. That all is a part of the net proceeds. So if you got a $5 million net proceed nugget that you're trying to get out of an $8 million sale, you can architect it with all these different types of deals. So can you elaborate on how those different things are classified and how to approach that when you're looking at the whole picture?
Well, certainly happy to at least provide some insights. When we're looking at a transaction, and by the way, a best practice for business owners is to really understand that a successful transaction or transition, if you will, probably takes 3 to 5 years. You really need to be thinking a year or two at least in advance of a potential sale to groom the company, to get it ready for the fashion show, if you will, where the attributes of the company will be championed. And you want the company to be as favorably, postured and positioned as possible. And that, from the standpoint then of, looking at net proceeds and how to at least try to strengthen your position, be aware of the fact that there's certainly going to be some terms that will be far more favorable to the buyer. So you want to have a strong attorney representing your interests so that the terms that are not favorable to you are at least blunted. That if you're providing, if you're extending credit through a seller note, typically the buyer wants to have that note secured only by the assets of the company. And you have to be really tough and say, no, there's going to be a personal guarantee on that note. And or a specific pledge of additional assets to make sure that note is good. As far as earnouts, I'm just providing a couple of examples.
Yeah, I like it.
With earnouts, business buyers will say, well, we think it's fair. If the company is doing well after the transaction, we think it's appropriate. We think it's appropriate for the seller to participate in that future profitability. So they'll champion profitability. Yes, you can participate in that. The earnout will provide or have provisions. But who determines the profitability going forward? It's the buyer. And, you're never going to know what corporate allocations and what overhead is or how they've changed the cost structure. And I'm an old gnarly German CPA. I've done all this.
Well,
I was going to say, if there's an earnout, have it attached to something that's easily verified, like sales,
right,
and not profitability or net results.
Well, and so a couple things to elaborate on that too, because with an earnout, I believe that, and from our experiences, that why wouldn't the buyer want to have as much of the sale? So if you got a gross $10 million business, why wouldn't they push as much into that earnout as they possibly can? And again, this is where the give and take comes, right? Because that earnout, again, subject to their own control. So if you're the seller, you go and you sell to the buyer, and now you're quote unquote an employee. Like you said, you don't know whether they're running their personal expenses through that are dictating the profitability of your potential compensation plan. So making sure that you can control whatever it is that you're being held to, and then making sure that you get as much of the earnout as icing on the cake, and you get as much in a guaranteed or upfront fashion as you can.
Well, absolutely correct. And it even is such that with earnouts done properly, sometimes that earnout can attach to the initial transaction. It can be capital gain. Structured poorly, the earnout could just be ordinary income and taxable at ordinary income, the highest marginal rates there.
So what are the differences of those two situations?
Well, clearly, if there's an earnout and if it's a stock sale, there's much greater chance that the earnout will attach to the stock transaction and then likely be classified as capital gain. If it's an asset sale, then it depends on how the earnout would be allocated to ordinary income assets like inventory and equipment, or perhaps some capital gain, be it goodwill, personal goodwill, or corporate goodwill.
Well, that specific example that you just talked about, that scenario, is where we ran into issues. And actually, our needle swung for net proceeds a very, very large amount because there was no thought behind the different allocations in an earnout, promissory note, and some other things. So you're talking game changers for why you would have even done the sale had you not realized how different those different classifications could be.
Oh, very definitely. And I've taught courses on asset allocation pricing. I called it depreciation arbitrage. The buyer has a vested interest in allocating as much as possible to those asset categories, promising quick, turnaround and recovery, like inventory or equipment that's in the facility. The last thing that the buyer wants to buy in most cases, they don't want a lot of goodwill, because it's amortized over 15 years. They'd much rather they'd rather allocate to inventory that turns every 90 days or so. Um, so it can be a huge game changer under the category of more bad news. Uh, when a company is sold, there's a tax form that's filed, and both parties should agree that they're consistent with the allocation of the purchase price to the assets, but they don't have to be perfectly in alignment.
Well, this kind of just shows that if you don't know this game, then the buyer is going to be controlling most of the process, and they're just going to be allocating things wherever they want, which could significantly change plus or minus 30% on your net proceeds.
There's absolutely correct. And in a lot of cases, buyers will put in their offer to purchase that you agree to their asset allocation. That's a stipulation. And that's usually buried someplace in the, and you need to be very, very careful about that because, they're allocating to asset categories offering the highest recovery of costs. In most cases, it's ordinary income to the seller. You're right, that can be a tremendous game changer as far as net proceeds on the sale of a company.
And another reason that you want to make sure your attorney is CPA is actually in the business of doing this. Like in our situation, I think we had our business and employment attorney doing that. So this is not a 401k document. This is a actual purchase agreement to sell our company.
That it doesn't necessarily mean the parties are adversarial, but it is an economic transaction, and the larger the transaction, you start approaching several millions of dollars. Shading this thing a couple of percentage points, one way or the other, is real serious money.
Yep. After we were talking about this net proceed topic, I think it's a great lead into why you're doing what you're doing today, because you found yourself in the world of ESOPs. And we've had another gentleman that we talked about the high level of ESOPs and kind of the structure of it. But can you give us a little bit of a rundown on your story and how you ended up there and why you have kind of ridden this wave?
Well, certainly. And with most careers, there's always a large element of luck. I was CFO for a manufacturing firm that had just gone through a leverage buyout. So this goes back many years into the 1980s. And the company used as part of the buyout consortium an employee stock ownership plan, an ESOP. Back then, hardly anyone knew about ESOPs, and I was thrust into this position of, I really need to know this. So we had several board members, outside board members. They were really outstanding. And so I went to Washington, the ESOP Association, and really, really got to know this inside and out. The company was enormously successful, migrating from a really not going anywhere, closely held manufacturing firm, a lot of injection molding, to within about three years to world-class manufacturing. And there was a lot of cheerleading and a lot of engagement, a lot of employees were really brought on board. We were championing the fact we're an employee-owned company. So that really made a big difference. It was a very autocratic company prior to the transitioning. So I stayed with them for many years. They were good to me, but still serial entrepreneur. And started Enterprise Services as a consulting firm, but almost immediately found the niche in ESOP consulting. I was a CPA, and having come from industry and being a trustee for the ESOP at the company, and then riding this wonderful curve. The company quadrupled in size in a very short period of time. By the way, cash flow was smoke and mirrors. We had no cash. We were just growing nicely, but it was all on borrowed money. Trust me.
I want to go back to that after you finish your story.
At any rate, found the stride, and I gained disfavor. I mean, I didn't like paying taxes, and the world of ESOPs is very tax incentive centric. So it was easy to champion the employee ownership.
So, as to go back when I interrupted you, I apologize. When you said you quadrupled in size and you didn't have cash flow, but you were growing nicely, explain when you're quadrupling in size and you're using borrowed money, how the tax incentives favor that situation.
Well, back then it was doubly hard. We were a C corporation, so we still had exposure to taxes at the entity level. But because all of our acquisition debt was tax deductible, along with the interest, it just turns out that we didn't have exposure to taxes, even though we were growing. We were very profitable, but because of the growth, inventory and receivables and capital expenditures were just consuming the cash, especially when we were on such a rapid growth curve. So we had lots of deductions, but the only way that we could really sustain the growth was with more debt.
Got it. As you found yourself specializing in the ESOPs, how does an ESOP affect the net proceeds of a business owner? So if you wanted to sell his company, in the last interview I had around this topic, we talked briefly on it, but because we've gotten into some of the more technical stuff already about net proceeds, how does it affect that whole situation with allocation in the transaction?
Well, generally, one of the huge pluses, and there's a tax environment to the seller and to the buyer. Let me address the seller first. For most closely held companies in the middle market, most all those companies, I call them Main Street companies, so industrial distributors, professional service firms, manufacturing companies, construction companies, almost all of them are, if they sell at all, they will be asset sales, flat out. The huge plus with an ESOP is that the ESOP by statute is only permitted to acquire the stock. So to the selling shareholder, at a minimum, it's going to be capital gain. And without getting into the weeds, there can be even a tax deferral on the capital gain if the right circumstances exist. So that's a huge plus for business owners. Another huge plus for business owners is that they are in control of the process. They decide how much stock would be sold, when it's going to be sold, and to a degree, most of the terms. They don't determine the price. That has to be negotiated by a trustee. But that's a huge plus to the business owner. Again, they decide when the transaction is going to occur. If it made sense to do a transaction on December 30th, it could be structured to do that. When you have an independent third-party buyer, such flexibility usually doesn't exist. You're on their timeline. For the buyer, for the ESOP, the tax benefits are almost truly unbelievable. Most companies today are what we would call S corporations. And today, most companies thinking about an ESOP, they want to be 100% employee owned. All the stock is owned by the ESOP. Well, why is that? A 100% S corporation ESOP, and here's the unbelievable fact, they're income tax free. They pay literally no state or federal income taxes today, tomorrow, the next day, or ever.
Sounds pretty sweet.
This is an easy sell when you're in California and the highest marginal rates are 52%. How does zero sound? Keeping in mind that's the company. But the short answer is that as corporations don't pay income taxes, none of them do. They're passed through entities for tax purposes, so the shareholders are going to get the tax hit. If the only shareholder is the employee stock ownership trust, it's a qualified plan under ERISA, the trust pays no income taxes. Now, the company will have a repurchase obligation long term. As employees leave, we have to make a market for their stock. We redeem it, but we don't have any income tax liability whatsoever. And that is really a game changer. It means basically that all debt, any debt, for buildings or for the acquisitions or repayment of the acquisition debt, all the debt's repaid with pre-tax dollars. The rest of the world repays that same debt principal with after-tax dollars.
Isn't that crazy? I mean, just think about what that does if you're trying to grow and acquire companies. I mean, you could technically pay a little bit more for a company to win the business or whatever it might be because you're paying significantly less for that company.
Yeah, absolutely. Now if we had 3 more hours, I'd get into the weeds and everyone's eyes would glaze over, so we're not going there. But you're absolutely correct. What we found with a lot of our clients, we've been involved with now hundreds of ESOP companies. For these companies that are 100% employee owned, and if they've been in an ESOP, an employee owned company for 8-10 years, virtually all the acquisition debts repaid, they're cash flow juggernauts. They really generate cash, even though there's a repurchase obligation. Their tax benefits dwarf whatever obligations we have on the repurchase obligations. So the companies are really in a position, if they would so choose, to diversify and acquire other companies. I spent a lot of time in boardrooms explaining how companies can use their attributes, their tax attributes, to grow on a very tax preferenced basis.
I love it. So one of the examples, I'd like to hear your thoughts on the example that I give people, because they're like, well, how is it possible with the taxes? And if you think about just like a normal company's 401k, it's all pre-tax, right? So all the matching, everything happens pre-tax because it's a retirement account. And then the employee, when they retire, they take their few $100,000 or $500,000, whatever it might be, and then they pay taxes as they use that money. And it's the same structure, correct?
That's absolutely correct. And that's really consistent. Even with an F corporation, the financial success of the company will be taxed to the shareholders or to the stakeholders once as ordinary income. And that's true even with an ESOP. The deferral could be many, many years, but when the distribution's made, when the employee leaves and retires or outlives the employment of the company, the proceeds will be taxed as ordinary income as they're taken. Now, they can elect an annuity or they can roll it over and take distributions according to ERISA laws and the like, but ultimately, you're absolutely correct. It will be subject to ordinary income taxes. Ostensibly, if they're older and they're retired, the marginal income tax rate is probably much lower.
So what are the reasons that someone wouldn't do an ESOP?
Well, ESOPs do come with a rule book. They're subject to oversight by both the Internal Revenue Service and the Department of Labor. One of the key issues is that even though the tax benefits are legion, they're second to none, certainly from the standpoint of the ESOP, it's really the employee stock ownership trust that owns the stock under, ERISA and the like, that the trust has to have a trustee, and the trustee is subject to a very high standard of conduct, fiduciary responsibilities. So if business owners are leery of having to live under a rule book, then the ESOP may not be that attractive, even though there's some tremendous tax benefits.
Well, it's interesting, too, because regardless, they probably have a 401k, which they've got a fiduciary responsibility to their employees anyways. So they're in turn already have all these hats that they're wearing. It's just they're using their own company as a retirement plan, so they have to be a little bit more transparent with their own books.
Well, there's another thing that's misunderstood in a lot of cases with ESOPs, that the senior team, the successor senior team, can look at the ESOP and think, well, we're doing all the heavy lifting here. We're doing all the managerial things. We're, guiding the company. We're repaying the debt, and yet all we get is salary and participation in the ESOP. Well, not really. In today's world, we want to provide some incentives for the senior team to grow the business and to stay with the company for a period of time. So these employee-owned companies are very frequently matched with incentive programs and retention programs for the senior team. And it's fairly routine now where the senior team is granted stock appreciation rights or phantom stock. So that's a carve out of additional financial gain to the senior team that really is tasked with making good things happen. The ESOP companies have to be managed. It's not management by committee. You need a senior team that's in there. So the senior team members can really be well and fairly compensated, even with an ESOP, even if the trust owns the stock of the company.
I love it. We could, I know you and I could go on for a long time, because every one of these topics that we've talked about, you can go so far down into
right.
It's all important too, because this is how you level the playing field, in my opinion, between the buyer and the seller. Because the business owner, instead of winning the next customer or taking customer service calls, this is the business that they should be. They should learn this, because it significantly changes the game towards the end outcome. How can our listeners get in touch with you, Scott?
Well, of course, the easiest way is Scott Miller, and our company here is Enterprise Services, Inc. Our phone number is 262-646-6490, and then an email address is smiller@esi-enterprise.com.
If there's one thing that you'd leave our listeners with, what would it be?
Well, I think that I'm assuming that so many of the listeners are business owners, is that transitioning is a journey. It's not just the event, the actual date of closing, and that the informed business owner understands it's a journey and realizes it's going to take some time and some very good strategic planning to have a successful outcome.
Awesome. Thanks for coming on the show, Scott.
Well, thank you for inviting me. Appreciate it.